Hi students, how are you? In today's lesson, we are going to discuss lease accounting standards for lease, IFRS 16, SLFRS 16, right? Sri Lanka Financial Reporting Standards 16 and International Financial Reporting Standards 16. Okay, as per the mostly both accounting standards are very similar. There is no big differences, so contents are same. Okay, so directly we will go and see what is the initial recognition, right? What is, there will, I as I told you in earlier lectures, there is a initial measurement, definition and initial measurement, subsequent measurement and disclosure, and subsequent expenses and everything are defined. So here we will say what is the lease assets. Before going for the initial recognition, we will see what is the lease assets. Lease, what is lease? Normally the meaning of the lease is, if the businesses or a person, right, uh, if he wanted to purchase an asset, maybe it may be a building, right, building or maybe vehicle, buildings or vehicle or land, right? We say land, building, land, 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 right? So the person who is involved in the businesses or the people who have in private life would like to go for the purchase of land or building or vehicle, to purchase the vehicle. In such cases, uh, every people have a desires. Okay, every people have desires, but to meet that desire or to satisfy that desire, you need money, money or cash, right? Money or cash. So maybe the person may be involved in the business, he may would have deriving profits, he may would have drawing profits from his business, or the person who is working in an organization, he may have he may be receiving the salaries, right, as a compensation for the services offered. So those people, what they can do is, they can, even though they don't have enough money or cash, right, even though they don't have enough money or cash, still enough money, short of money, right, short of money, short of money, right, still they can purchase an asset. That means the asset may be a land, maybe a building, maybe a vehicle, right? So that may differ person to person. The requirements and desires may differ from person to person. Okay, if that person, so he is running short of money, right, to purchase a land or building or vehicle, but if he has income like a profit generated from small businesses or big businesses, or income he's getting as a compensation for the services rendered to the organization, and things so on and so forth, he may can approach a financial institution, right? He can approach a financial institution institution to get a loan or purchase a land or building or vehicle, right? So what this financial institution will do is, this is the seller, right? Seller, right? This is the buyer. Buyer will approach the financial institution, right? Seller, right? Buyer. Okay. Buyer. Buyer will approach the financial institution, right? Requesting for help to purchase a land or vehicle, land or vehicle, land or vehicle or building, right? Right. He want to purchase, right. Purchase it. So what this financial institution do is, the they will help him to transfer the goods, right? Transfer the property, right? They will transfer the property, plant or equipment, right? Property, plant or equipment. They will, the seller, the cash is paid by the financial institution to the seller. The cash settlement, full cash settlement, full cash settlement done by the this financial institution, right? They will, this buyer approaches the financial institution. The financial institution, what they does is, they will purchase, what they do is, they will do the purchasing from the seller and transfer the property, not the transfer, ownership of the property, ownership property to, with the finance institution, right? Ownership, right to use the asset. The person asset is with the buyer, asset with the buyer, with buyer. He has the right to use the asset, right to use asset. asset. He has the right to use the asset. So the buyer has in possession of the property. Risk and everything is borne by him. Right? He has the right to use. Whereas we have seen in the contracts for the income, in the contracts of the income, in contracts for the income, they says when the right is transferred to the buyer, the buyer is become an owner. Buyer is become an owner. So here right is transferred to buyer, but this is an exceptional situation where the even the right is transferred to buyer, the ownership is not with the buyer because ownership documents are in the name of financial institute because he has not settled the whole amount of cost or selling price, right? Because this is the lease agreement. This is lease agreement called lease agreement. Lease agreement, right? The agreement between the buyer and financial institution is the lease agreement. The buyer is called as lessee, right? Buyer is called as, in this scenario, buyer is called as lessee. The seller, the person who is executing the lease agreement, is known as lessor. Lessor. He is lessee and he is a lessor, right? So now I feel you would have understood what is the meaning of lease and who is the lessor, who is the lessee, and even though you don't have the enough cash, you can still purchase property, plant and equipment under the lease agreement, right? What this lease agreement will, under that lease agreement, right? This is the what you call small picture I am showing you, right? Under the lease agreement, they will determine lease terms and requirements. Under the lease term will be determined there. Maybe if you say 10 years time for land or building, 10 years time of building, 10 years, right? Under the lease agreement, this 10 years or 20 years or 5 years, it may differ. That depends on the agreement between the individual buyer and the financial institution. Okay. So if it is a 10 years lease agreement, after the lease agreement, okay, the financial institution may transfer the ownership at the end of the lease agreement, right? And may hold the the ownership by lessor. The lessor means the financial institution who is executing the lease agreement. He may transfer the ownership at the end of the lease term to the buyer, right? So if the lease agreement says at the end of the lease agreement the ownership will be transferred to the lessee. Lessee means the purchasing buyer, to the buyer. Buyer is called as lessee. Seller is called as, not seller, the person who is executing the lease agreement is called as lessor. Okay. So if they agree, useful lifetime is 25 years. Useful lifetime. Useful lifetime, what is the meaning by useful lifetime? You may know up to 25 years only the property can be used in the production or in the usage. After that you cannot use. So this property has the useful life of 10 years, 25 years, whereas you have entered into an agreement for lease agreement for 10 years. So still 15 years you can use the same property. So this ownership after 10 years transfers to the, after 10 years we see this is buyer, okay, this is buyer, this is financial institution, this is lessee, this is lessor, right, lessor. Okay, so after 10 years, 10-year time, after 10 years if the property transfers to lessee in the sense ownership, ownership ownership transfers to lessee in the sense he, one option is he can transfer this ownership to him. Another one is ownership still retained. He may retain in the ownership, right, after 10 years, right? That is depends on the lease agreement. Okay, so if it is, if he is going to retain the ownership, then 10 years the installment for 10 years he is using, lessee is using the property now, for that he will pay a payment installment yearly, annually he will pay a installment payment year by year. Lessee will pay the payment to lessor for usage of, for the usage of the property, right? Payment, this payment is called as lease rental, lease lease rental or installment, right? Install, if he is going to hold the transfer of ownership, he is, if the finance institution, that means lessor, if he is going to hold the, retain the ownership, the lease installment would have been lower than the installment paid at the time of ownership is transferring to the lessee. Okay, that depends on the situation. So you know what is the lease rental or lease installments, monthly installments, and when he is charging the lease payment, the lease payment will contain lease payment, right? Lease payment. This lease payment installment will consist two part, that is capital and interest, right? Capital and interest, right? So when we are doing the sum, we can treat what is the charges for the interest, what is the what you call pay interest charges, what is the accounting treatment for interest and capital, so on and so forth. Okay, so now you would have got the idea what is the lease agreement, what is the lease, how do you can purchase an asset on lease, and who is the lessor and who is the lessee, the intermediary act, that is between seller and buyer. The financial institution is acting as intermediate intermediary person to purchase, to supply the goods on lease, right? So you got the picture. I think you would have got the picture up to this. Okay, lease installment gets the lease installments consist of capital and interest. Up to that knowledge is more than enough for you now, and we will see now. Now we can see what is the lease. Lease international financial reporting standards number 16 says what about the what the international report financial reporting standard says about the lease, and Sri Lankan financial reporting standard 16 what that standard says about the lease in the books. We can see now the lease is initially recognized initial recognition initial recognition in the sense initial measurement of lease, initial recognition and initial payment, sorry, initial recognition and initial measurement both are same, right? At the stage of initial recognition, right, this I am going to raise it, right? If now if you want you can take it down this section, right? In the at the time of initial recognition, the lease agreement, no sorry, at the time of initial recognition or measurement, we identify the right of use assets and lease liability, right? Right of use assets and lease liability. Okay, so I am going to raise this one. Okay, right. So what is the right of use assets? The assets transferred, or the assets, the right of use assets is assets on lease. Assets on lease, that is known as assets on lease, right? If you know, as I explained to you, if you bought a vehicle on lease, that is defined in the standards International Financial Reporting Standard, it is defined as a right of use asset. Right of use assets, by the term of right of use assets, right? The lease liability. The lease liability is the present value. We will see later on here. Right of use, what is the right of use, and lease liability, right? In the right of use mean right of use assets measured at the amount of lease liability plus any initial, right, by any initial direct cost incurred by the lessee, right? If you say measured at the amount of lease liability plus any initial direct cost, that means the assets on lease is purchased by, if you say for an example 100,000, right? The initial payment of what you call lease agreement, that expenses would have been incurred. That initial payments also direct cost, any initial direct cost incurred by the lessee. And if you bring that property to the initial the at the present location and condition, what are the costs incurred, that also will be added to this. That those costs incurred by you, not the lessor. It is not paid by the lessor, you are incurring, right? Transportation cost or any other cost to bring that property to the present condition and location. So that amount is also has to be added. Those are direct cost involved, right? Here, right of use assets gets a lease liability. Lease liability, right? What is the lease liability? This whole, not the direct cost, this is the lease liability, 10,000 rupees. 100,000 is the lease liability. Right of use assets account debit and lease liability is credit, right? The right of use assets we used to show as an asset, current assets in the balance sheet, under the balance sheet. Lease liability we are showing as a liability in the balance sheet. Okay, that is what they have mentioned. So I am mentioning here in point form: lease liability, initial direct costs, estimated cost of dismantling. So at the end of the useful life, we may have incur and expense to dismantle that, to the to dispose that particular asset. For the land, you won't get the dismantling charges, and you won't incur. For vehicle, you may incur dismantling charges. For machineries, you may incur dismantling charges to remove that machinery from your factory premises and to discard the machinery. You may discard it somewhere else, right? So you may incur a loss, incur an expense for that dismantling and disposing. So those costs are also has to be added to this cost, right? That's what they said, estimated cost for dismantling, right? Then the next one is payments less incentives before commencement date. Before commencing, they would have given some incentives or something like that, then that has to be deducted from this cost, right? Any incentives, discounts or any other things. Okay, that is these costs are known as That's what we have mentioned. While I'm talking about the right of assets, here right of assets, right? Now you know what is the right of assets, right? So now we will get to know what is a lease liability. After getting to know the lease liability, we will say what is the subsequent measurement, right? This is the initial measurement, right? We are looking at the initial measurement. Measurements are two types: initial measurement and subsequent measurements. So now we are looking into the initial measurement. Under the initial measurement, right of issue, right of use assets we have seen, and lease assets, lease creditors we are going, that is the lease liability, that is we are going to now see. That is what here I have mentioned in the short form, right? Measurement is divided into two. One is initial measurement and subsequent measurement. Both things, right of issue, right of use assets and lease creditors are there. Right of use assets and lease creditors are there. Right? Initial measurement is something different from the subsequent measurements. Right? This is the initial measurement. We are talking about the initial measurements. Right? Now we are talking about the initial measurements. Right? Right? Initial measurement. We have seen right of use assets in point form. Here I have mentioned, you know what is the right of use assets, right? The cost, how you determine the cost, initial payment excluding the incentive payments, right? And direct cost, any direct cost incurred when you are installing that particular machinery or bringing that property to a place. And estimated dismantling cost. Estimated dismantling cost. Now, lease liability. Under the lease liability, what is lease liability? Lease liability. Lease liability is measured at the present value of the lease payments. Present value of the lease payments. Right? Payable over the lease term. Present value of the measured at the present value of the lease payments payable over the lease term implicit in the lease discounted at the rate. Discounted at the rate. Right? So, lease liability, we have to take the present value. Right? Present value, we have to take and do the calculation. That is fixed payments less incentives. Fixed payments less incentives. As I told you, we have to deduct the incentives. Variable payments. Payments may be variable. Expected residual value guaranteed. Residual value will be there. And penalty for terminating the penalty will be there for the terminating the lease agreement. Right? And a penalty in the sense, if you default any payments, you are involved the penalty. They will charge the extra charges. If you are terminating the lease agreement, there will be a extra charges for that. So that is what they are mentioning, the penalty for dismantling. Right. Next one is exercise price of purchaser. Price of purchase option. Right. That is, you can purchase at the exercise price of purchase of option. You have the right to purchase that the assets at the end or not. That option is available under the lease. Right? Note, if the rate implicit in the lease cannot be determined, the lease shall be used there borrowed. Here we will see present value of future installments. Lease creditors present value of the future installments. We have to get the present value of the future installments. Okay, that is the lease creditors. Next one is subsequent measurement. Subsequent measurement, right of use assets cost less accumulated depreciation. Right, cost less accumulated depreciation. Here you see cost model, fair value model, revaluation model. Right, subsequent depreciation is cost less accumulated depreciation. Subsequent measurement is right of use assets cost less accumulated depreciation. Cost of the goods at your financial statements, apart from if there is no revaluation model, if we are going for the cost model, okay, if we are going to the cost model only we have seen here, right? Normally we used to go for the cost model. So now we are discussing the cost model. Cost under the cost model, not the fair value model, not the revaluation model, right? Model, right? Under the cost model, we used to cost less accumulated depreciation. Cost less accumulated depreciation. Financial liability at amortized cost. Financial liability at amortized cost. The fine that is we can take, we can see later on. Initial liability plus interest minus installments, amortization, right? This is the installments, this is the amount we had to show at the latter part. Lease liability, financial liability at amortized cost, right? uh, that is the subsequent measurement. So you have you now know initial measurement, what is the initial measurement and what is the subsequent measurement. Under the subsequent measurement we have seen up to cost model, not the fair value model. Fair value and revaluation model we can see at the time of what you call sale of assets, sale of assets and lease back, sale of assets and lease back, right? That is what, yeah, under that term we can see what is the fair value model and revaluation model. Revaluation model, you know the revaluation model, right? What is the accounting treatment? We can see the what is the accounting treatment. Initial payment, for the initial payment, right? Right of issue account, right of use assets account debit, cash or bank account credit, right? Initial payment, right of use assets debit, cash or bank account credit, right? Second one is, you know now for initial payment what is the double entry for the assets? Right of use assets is say asset, assets they have mentioned itself. Cash and bank is credit. Lease liability, that is lease creditors is the lease liability. Right of use assets account debit, right? Right of use assets account debit, lease creditors credit, right? Lease credited credit. This is the initial payment, this is the subsequent payment, that means lease liability, the installment payments, right? Right of issue assets account debit, lease creditors account credit. This is a lease creditors. Lease credit, when we are paying the interest, interest expenses, lease creditors or interest, lease interest, right? Lease interest, lease interest, interest expense account debit, cash and bank account credit, right? Cash and bank account credit. When payment of installment, lease creditors debit, lease creditors debit, cash and bank account credit. Lease liability is different. Lease liability, this is the initial payment, and lease liability is the present value of the installments, right? Present value of the installment, that is right of use assets debit and lease creditors account credit. Here payment of installments, lease creditors debit, cash and bank credit. Depreciation expense account debit and accumulated depreciation account credit. These are the 5 accounting entries associated with the lease. So for those 5 entries I have given here, right? Now before go to the sale and lease back, under the lease IFRS 16 and SLFRS 16, we will do one sum under this and small sum too for your understanding. Thereafter we can see the sale and lease back, right? Sale of the asset, of an asset, and lease back, right? So under that we can say fair value and revaluation. Revaluation take place when sales take place on things like that, right? Okay. So under the lease accounting, on 1st January 2018, right? On 1st January 2018, PR entered into 5-year lease machinery agreement, right? The machinery has a useful life of 6 years, right? Lease term 5, right? First of all, lease term. This is different answer, right? Answers, right? Lease term, lease term 5 years, 5 years, right? 5 years. And the machinery has a useful life of 6 years. Useful life, before that we will see under the subsequent measurement we have mentioned depreciation is based on the earlier of the useful life, right? Useful life or lease term, unless ownership transfers. When you are making a depreciation in the according to the lease IFRS 16, when you are making under the lease, when you are making the depreciation for the lease assets, you have to take the earlier period of useful life for lease agreement, whichever is the earliest one. If, right, if ownership of the property is transferred at the end of the lease agreement, then you have to take the useful life of the the original useful life of the asset. Okay, original useful life. If you say, if you are at the end of the what you call the lease period, the ownership is not transferred, then uh, useful life lease under the lease term is 5 years, useful life is 6 years, right? If if the this particular asset is not, ownership is not transferred to the lessee, then you had to take with this whichever is earliest. Earliest is lease term is earlier than the useful life, 6 years. Lease term 5 years, useful life is 6 years. Then earliest one is 5 years. Lease term is 5 years. Then you have to take the 5 years for the depreciation purposes. If the ownership of the property is not going to be transferred at the end of the lease term. Right. If the ownership is transferred at the end of the lease time, in the sense, if the ownership is transferring to the lessee at the end, then you will have to take the useful life as 6, right? So the machinery has a useful life of 6 years. The annual lease payments are 5,000 per annum. Annual lease payment, lease lease payment, and it is 5,000 per annum, per annum, right? With the first payment made on 1st January 2000 and 1st January 2019, first payment is made. 18, sorry, 18, right? To obtain the lease, peer incurs an initial direct cost of 1,000. Direct cost is 1,000. He is incurring a direct cost of 1,000 in relation to the arrangement of the lease, but the lessor agrees to reimburse peer, agrees to reimburse 500 out of 1,000. He is incurring directly, he is incurring 1,000. Out of 1,000, the lease person, the person who is leasing out, going to reimburse 500. That is incentive towards the cost. The rate of implicity is 5%. The rate of implicit, the lease is 5%. 5% is the interest. 5%. The present value of the minimum lease payments, present value of the minimum lease payment is 22,730. This is the present value. They have given the present value. If they have not given the present value, you have to refer the table, present value, discounted value table, right? There we have to see the present value, right? How many years and percentage. Okay. So demonstrate how the lease will be accounted in the financial statements over the 5 years period. Right? They want to know how we are going to treat the amount. Right? First of all, we will do the workings. right? Workings. That is year, year, right? Year, right? Year and brought forward balance, right? Payments, payments, brought forward balance, payments, capital, finance cost, 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 and carrying value, carrying value, carrying value. Year 1, year 2, year 3, year 4, year 5, right? Year 5. Up to year 5, right? Up to year 5. We do the calculation at first, right? First year we have 22,000, present value is 22,730. He is making the payments at the beginning, 5 years, 5,000. At the beginning itself, they are making the payment, right? Then the finance cost will be how much? Present value of the asset is 22,500. 22,730 minus 5,000 is 18,000. 18,730. 18,000. Right, 18,730. Then what is the interest portion? Interest portion 18,530 into 5 divided by 100. That is right. That is 818,000. So it is not 18,000, 17,000, right? 17,000. 17,730 into 5 is 886. Finance cost is 886. Right. If you deduct the 508 from 17,000, you get 8, you had to add it 18,670. 18,617. So 18,617. You are deducting 5,000. You are making the payment 5,000. Then 13,617. Then 13,617 into 5 into deduct 100. 5%. Then you will get 681. 681. Then 14,298. 14,298. 14,298. Again you are paying the 5,000. Then you will get 9,298. 9,298 into 5 into 5, that is 465. 465. If you add 465 with this 3, 1, 6, 7, 9,763. 9,763 divided by 5,000. Right, 5,000. If you deduct the 5,000, 4,763. Then what is the interest? 237. 237, and you will get the 5,000. At the end of the 5 year, 5,000 and 5,000. No. Right? Understood? Have you understood this method? Year 1, year 2, year 3, year 4, 5. Brought forward balance, that is the present value. Payments every year we are making the installment at the beginning. At the beginning, that you have to note of it. If the payment is made at the end, then you have to calculate the interest on 22,730. But here the payment is made at the beginning. So payment is made at the beginning. So you have to make a interest, pay the interest for 22,730 minus 5,000. Then 17,730 only you have to calculate the interest. That is 886. Right? If you take note of this, it's okay. Okay. So this is the working for first year. What is the payments? What is the brought forward balance? What is the capital amount? What is the interest? Right? What is the carrying value? Everything you know. Now we will go to the question and see what is the they have asked us to do. They ask the present value of the minimum lease payment is 22,000. Demonstrate how the lease will be accounted in the financial statements over the 5-year period. Right? Here we will say first double entry is initial payment. Initial payment. Initial payment. Right? Initial payment. We will see what is the initial payment. For the initial payment, we have to say here is we don't have the initial payment. We are doing the installment payment only. So for whole amount we are making the lease, right? So lease liability, right? Lease liability, right? Lease liability, we have to create a lease liability first. First lease liability is, first we have to create a lease because here we didn't pay the initial payment, right? Only the installment. For whole amount we have made the liability. These liabilities, right, right of use assets, debit, how much? 22,730. And lease creditors, two lease creditors, credit 22,000, right? Credit 22,730, right? 22,000. Second payment, what is the payment we are receiving is making the payment is indirect cost. Apart from initial payment we didn't take, but we are spending another expenses, uh, indirect cost. Indirect cost, right of use assets, debit 1,000, and cash for bank credit 1,000, right? This is for indirect cost, payment of indirect cost. In cost, indirect cost, right? Third one is reimbursement of indirect cost. That is cash or bank debit 500, right? 500. Right of use account to right of use assets on credit 500, right? And being reimbursement of cost, direct cost, right? Next one is, fourth one is payment of installment, lease creditors, payment of lease debit 5,000, cash or bank or bank credit 5,000, right? Being payment of installment, being right. So now what they have asked implicit and demonstrate how the lease will be accounted in the financial statements over the 5 years period. We have seen, and this is the double entry, right? How we have to see show, right? And we will say what is the this is the double entry journal entries for the payments for first year payment, right? First year payment and interest also we have to calculate interest payment. These all I these five will come, right? Interest, these interest account debit, these interest PNL debit. How much? 886. 886. Cash. No, not cash. Oh, cash or bank account is lease creditors. Lease creditors. Lease creditors. Credit. 886. Because we have to remove the 886 from the lease creditors because this 5,000 include the interest portion, right? Interest portion, lease creditors account debit and cash and bank account, no, we have credited, right? Where the lease creditors lease interest is consists the 5 included in this 5,000. So we have to eliminate that from the 5,000. Then only lease creditors will show the correct amount. Okay, so we have eliminated that amount. Okay, or we can say lease interest account debit and lease creditors account lease creditors payable is interest being adjustment for payable, right? Interest payable being adjustment for interest payable, being interest payable, right? We can pay, we can show lease interest payable separately, or we can add it with the lease interest creditors, right? But we have to show in the balance sheet if it is payable, it should be, interest should be payable within the 12 months. So we had to show it another 12 months. Lease interest and payable amount. Okay. So this is the entries you need to, if you want you can take it down, otherwise we can put the T accounts and see, right? So I am going to raise this part and show you the T accounts, right? If you want you can take it down. The depreciation, for the depreciation also we have to make a entry, right? So in the T accounts, when we are doing the T accounts we can show. Okay. I'm raising. For 5 years we have to make a entry, right? So what are the accounts we need? Initial payment for right to use, right to use, right to use account, right to use account. 1 2 3 4 5, right? And another one is lease liability lease liability account. Okay. Lease liability, right? Or lease creditors, lease lease creditors, right? Lease creditors. Another thing is interest, lease interest, expense, right? Expense account, lease interest, right? Expense account, payable balance sheet account, right? Right. Lease interest, lease, right? And depreciation, right? Cash and bank and depreciation. Cash at bank, depreciation, depreciation, depreciation expense, accumulated depreciation, right? So these are the accounts we are going to maintain, right? First year 1, right of issue account, debit 22,000, 22,730. That is lease creditors, lease creditors, creditors. This is right to use assets, right? That is 22,730. 22,730. First payment, right? And the other payments, you know what is the other payment is? Direct cost. Reimbursement of direct cost. Reimbursement of direct cost. Direct cost. Direct cost, that is okay. Direct cost. Direct cost account, we are involving, right? We have involved a direct cost of 1,000. Cash account credit 1,000. That is direct cost. Direct cost year 1. Year 1 direct cash and bank. Cash, right? 1,000, right? We don't need to open a direct cost account, right? Direct cost. So what? Cost 1,000. Direct cost is 1,000. Out of 1,000, we were reimbursed by 500. 500 reimbursement in the sense cash account debit 500. 500 cash debit, right? Right to use account. Right to use. Right to use. 1. Right to use. Right? This is 500, that is cash and bank. Cash and bank is 500. 500. Right? So cash and bank is debited and credited to right to use account. So here first year of operation, right? Then what we are going to do is lease creditors. We are making the installment payment of lease creditors, right? Lease creditors, we are making a payment of 5,000. 5,000 cash account credit, 5,000 lease creditors. Lease creditors account debit 5,000. 5,000, right? This is cash and bank. Cash and bank, 5,000. Here we have to show directly the interest component, right? Interest component has to be excluded from the creditors, lease creditors. So interest expenses is debit 886, debit 886, lease interest payable account, credit lease interest, right? That is 886, right? Year 1, year 1, year 1. So how lease interest is payable? This consists the present value, no? Present value, no? Interest, we have to remove the interest from here. So lease creditors account, debit 886, lease interest, lease interest payable, lease interest payable 886, right? That is lease interest. Lease creditors, lease creditors, creditors 886, right? We had to remove the interest portion from the lease creditors and pass the journal entry for the lease creditors payable. Okay, so it is finished. So now depreciation part is the only part is available for the end of the first year. So to do the depreciation, you have to find out the right to use account. Right to use account balance you have to find out. So we have passed the journal entries, all the entries to the right to use account. Now you balance the right to use account. Right here it is carried down value. So this is 23,730. This is 23,730. Then carried down value will be 23,500 230. 23,230. Brought forward balance 23,230. Right? 23,230 has to be divided by what is the lifetime? Lease term is 5. Useful life is 6 years. Lease term is 5. Useful life is 6 years. What is the question they says? Value but lessor agrees to reimburse 500 towards the cost of the lease. The rate implicit in the lease is 5%. The present value of the minimum lease payments 22,730. Demonstrate the. So we had to take whichever is the earliest one. That means they have not mentioned whether the ownership is transferred. So we have to decide that it is not transferred. If it is ownership is transferred, they have to mention it. So we will take 22,000, right? Depreciation amount equal to 23 straight line method. 23,230 divided by 5 years, right? So divided by 5 in the sense you will get 4,646. 4,646 is the annual depreciation. So 4,600 depreciation account debit 4,646, that is accumulated depreciation. Accumulated depreciation account credit 4,646 is the depreciation. Okay, this is a year 1. Year 1. This is year 1. So this is the first year adjustment for the first year. This is the workings. This is a first year adjustment. After that, you have to do the balancing. Lease interest transferred to the P&L 886, and this is no depreciation transferred to the P&L 4,646, and this is carried down 4,646, brought forward 4,646. Right here, lease interest, this one, right, 16 and 186, 23,608, 23,616, carried down value will be 18,616. 616, right, 616, right, it is balancing now. Brought forward 18,616. See, second year brought forward is 18,646, that is lease creditors, right. Interest is 86 paid, nothing. So this is the double entry you have to pass, right. At the end of the fifth year, the lease creditors should be nil, right, because of the limited space here. I am not going to do for the rest of the thing. Rest of the thing is easy. For right of use account, you are not going to touch the right of use account. Here you are going to do the payment. Second year, cash and bank 5,000, right. Second year, cash and bank. Second year, cash, lease creditors 5,000. Lease creditors 5,000. What is the lease interest? Lease interest is 681. 681. That is 2. Lease interest payable. Interest payable 681. 681. If you take the 681, you have to transfer the. This is go to the P&L. 681. This is goes to the lease creditors. Creditor 681. Then you have to charge it for the 681. 681 for second year leased interest payable. Lease interest payable. So I have to shorten it, this one, right? Right. Right. This is called 23,000. 23,000. How much? 23,616. Right. 23,616. Right. So brought forward is 18,616. Right. What you are going to do is now lease interest Cash is paid. Cash and bank. Cash and bank is 5,000 we have paid. Lease interest payable. How much? 681. 681. Then it is carried down. Right? 681. This 7. This is 9 to 19,297. 19,297. 19,297. Then 14,297. Brought forward 14,000. 14,297. 14,297 or 98, whatever it is, right? 98. So that is the second year. This is for the first year. This is for the second year. Like that, you have to continue. For this here, you will get 681. This also 681. This is 886. Right? So we have to expense. Provision for depreciation is second year also. Depreciation 4,646. Then it has to be transferred to the P&L 4,646. Here brought forward it is depreciation 4,646. 4,646. 2 and 9. 2 and 1. 9,292. Carried down 9,292. Brought forward 9,292 for the year 2. Like that, you have to go up to year 5. Here at the year 5, it should be nil. Right? These creditors should be billed. So I have done how to do the accounts. I am not going to do the whole thing. Right? So with this, uh, sorry. With this, I am going to conclude this session, and I am going to start the next session, or I will continue with this session on sale of assets and lease back. Sale of assets and lease back. Okay. So I hope you would have understood the lectures, and if you have any doubt, you again and again watch this video and you can understand easily. So sale and lease back is also we can consider the fair value model and revaluation model, right? Here we have considered only the cost model only we have discussed in this. Okay. Okay, thank you. Take care. Bye.